Aggregate limits in reinsurance treaties cap the total amount a reinsurer will pay over the treaty period for all claims combined. These limits are particularly important in non-proportional reinsurance, such as excess of loss XOL treaties, to control cumulative financial exposure. The purpose of aggregate limits is to protect reinsurers from unlimited liability by setting a maximum payout, allowing reinsurers to estimate and manage capital requirements effectively, and defining the cedent's risk-sharing obligations beyond the cap. Key features include a cumulative limit, which is the total liability for all claims during the treaty period, such as a €50 million aggregate limit, and a per-event limit, specifying the maximum payout for a single event. Aggregate limits are common in catastrophe XOL, liability treaties, and event-driven risks like hurricanes or earthquakes. They ensure coverage for high-frequency losses without overextending reinsurer exposure. The calculation of claims involves applying each claim or event to the treaty, considering the attachment point and limit. The total claims are tracked until the aggregate limit is exhausted. For example, with treaty terms of an attachment of €2 million, a limit per claim of €10 million, and an aggregate limit of €50 million, if claim 1 is €12 million, €10 million is paid, and €2 million is retained by the cedant. For claim 2 of €15 million, €10 million is paid, totaling €20 million used, leaving €30 million remaining. Once €50 million is reached, no further claims are reimbursed. In terms of variations, once the aggregate is exhausted, the reinsurer's liability ceases for the remainder of the treaty period. Some treaties allow reinstating the aggregate limit for additional premiums, such as one reinstatement for a €50 million aggregate, doubling the total limit to €100 million. For reinsurers, aggregate limits provide clarity on maximum exposure and facilitate better capital management and risk appetite alignment. For cedants, they offer comprehensive protection for large portfolios within defined parameters and allow risk sharing for catastrophic or high-frequency losses. However, there are challenges, such as exhaustion risk, where limits used early in the treaty period may leave cedants with uncovered risks, which can be mitigated by incorporating reinstatement options for additional coverage. Allocation complexity in multi-event scenarios can also arise, necessitating clear definitions of claim occurrence and aggregation in treaty wording. High aggregate limits increase reinsurer exposure, often resulting in higher premiums. Aggregate limits are essential in reinsurance treaties to cap cumulative losses and protect reinsurers from excessive exposure. While they provide clarity and control for reinsurers, careful structuring, like reinstatements and sublimits, is critical to balancing protection for cedants and ensuring treaty profitability.